If you think a company's prospects are good, you buy the shares and hope they go up. That's called being long. If you think a company's prospects are bad, you sell the shares and hope they go down. That's called being short. There's just one problem. If you think a company's going to do badly, how do you sell shares in something you don't already own? The answer is you have to borrow them. You borrow the shares from someone else. In most cases, you don't know who. Your broker sorts it out for you. You short the stock, then when you close the position, you buy the stock back, and at that point, your broker hands it back to the person the stock was borrowed from. That's how the process works. In reality, you just click on a button and computers do the rest. Shorting is a very risky business. If you buy a stock for a tenner and it collapses, you only lose your original investment. But if you short a stock at a tenner and it goes to 100, well, you can lose your investment many times over. If you're going to play the game, you've got to know the game. Do your research, manage your risk, all that kind of stuff. Now, there's no doubt shorting is a dark art, but it's also a noble art. It's how frauds get exposed. Not unlike hacking. Hacking can expose weaknesses. A couple of years ago, for example, a short seller by the name of Gabriele Grego suspected that a Greek retail company, Foli, was up to no good. Foli claimed to have 1,000 shops in Asia, Europe and North America. Grego got on a plane and went to see these shops for himself and discovered that most of them didn't exist. He duly went short the stock and exposed the malpractice. But just as short selling can sometimes expose fraud or bubbles or complacency, so it works the other way round. Many funds on Wall Street had been shorting crappy stocks for so long they'd got complacent. The financial industry can have a rather contemptuous view of retail investors, but some of the cleverest investors I've ever met have been in the retail sector. Some rigorously research company balance sheets, others analyse the fundamentals of a business or a sector, others use charts and technical analysis. Many share their research and opinions on chat boards. I get some of my best ideas from chat boards. How did people find out about Bitcoin? Chat boards. And so a few investors discovered that there was an excessively large short position in old school video games retailer Gamestop. They shared their findings. Over 100% of the stock had been shorted. If enough people bought the stock and held, the shorts would not be able to buy back the stock they borrowed. It wouldn't be available, except at much higher prices. The idea caught on, and all those retail schmucks piled on. They spent their stimulus checks buying call options, and the idea went viral. And one of the Wall Street hedge funds on the receiving end was Melvin Capital, which had quite loudly and vociferously shorted Tesla back in the day. So Elon Musk was only too happy to lend his support to the pile-on. The stock went from $20 to $480. A rabble of retail investors in a modern-day peasants' revolt handed Wall Street its arse on a platter. Some of them made out like bandits. I read of one guy who turned 50 grand into millions. Of course, it got shut down. Big tech took the conversation offline. Brokers such as Robinhood and others banned the trading of the stock. Some even closed the positions without the permission of the account holder. When a bunch of Reddit users coordinate to buy a stock, that's manipulation. When the government prints trillions to bail out Wall Street, that's banking. Now, the rebel is coordinating to do the same with other stocks, AMC, the cinema chain, clothes brand Naked, some of the silver mining companies. Let's hope those peasants took some profits, because big tech and Wall Street always win in the end. But in the meantime, let's savour a joyous victory for the little guy. He doesn't win very often. Come on!